Most people think investing is about picking the right stock. It isn't. Investing is a system with 8 levels, and at each level, the rules change completely. Most people spend their entire lives at level 1 or 2 without ever understanding why the levels above them operate the way they do. I'm going to walk you through all 8. Stay until the end. Because level 8 is not what you think it is, and once you understand it, you'll never see investing the same way again. Level 1. Beginner investor. You open your account for the first time. The screen looks simple. I sell, numbers moving. But none of it feels simple. You deposit $500, not a large amount, but enough that it matters. You're not just buying a price, you're buying a small piece of something real. That idea takes time to feel true. And because you've bought it, you start paying attention differently. Not just to the price, but to what the company actually does. How it makes money, why it grows, or doesn't. Some people are trying to predict the next move, others are trying to understand the business. That becomes your first real decision. What kind of participant do you want to be? At this level, your returns are almost irrelevant. What matters is learning how the system behaves. Because investing is not about reacting to every change. It's about staying in position long enough to benefit from it. Here is what nobody tells you at level 1. The goal isn't to make money yet. The goal is to stop being afraid of the process. Most people who never invest don't avoid it because they lack money. They avoid it because the downside feels certain and the upside feels theoretical. Getting past that feeling is the entire work of level 1. Level 2. Retail investor. You invest every month, not when the market feels good. Every month. You automate it. You stop making it a decision and make it a system instead. You build an allocation. 60% equities, 20% ETFs, 20% cash. Your portfolio starts to take shape, not randomly, but by design. The market drops. Your portfolio drops with it. Sometimes 10%, sometimes more. This is the first real test. Most people fail it, not because they make a bad decision, but because they make any decision at all. They sell. They wait. They try to time the bottom. You don't sell because you understand something now. Volatility is not risk. Selling at the wrong time is. You keep investing through it, month after month. This is dollar cost averaging. You are not timing the market. You are building exposure to it. Here is what most retail investors never figure out. The returns don't make you wealthy at this stage. The habit does. The person who invests consistently with average returns will almost always beat the person who tries to be clever about it. Because compounding is mathematical, and mathematics doesn't care how you feel about the market. Level 3. Consistent investor. Your portfolio crosses $100,000, and that number changes everything. A 1% move is no longer abstract. It's $1,000. A strong year adds $8,000 to $12,000 without a single new contribution. For the first time, returns feel real. You stop thinking about contributions and start thinking about compounding, about what the existing money does while you sleep. That shift in perspective is the defining characteristic of level 3. You set a target allocation and you stick to it, not because it's perfect, because consistency beats precision over decades. You rebalance based on percentages, not emotions. Market corrections stop feeling like a crisis. They feel like part of the process. Because the question is never whether the market comes back. The question is whether you're still in it when it does. You also start optimizing taxes. Because the difference between pre-tax and post-tax returns compounded over 20 years is not a rounding error. It can be the difference between financial independence and not quite getting there. Level 4. Advanced investor. Your portfolio crosses $250,000. And the question changes. It stops being, how do I build wealth? It becomes, how do I optimize how it grows? A 2% improvement in returns is no longer minor. At this scale, it means $5,000 to $20,000 per year, without touching your contributions. You start managing tax efficiency actively. High turnover investments go into tax-advantaged accounts. Long-term assets stay in taxable accounts. You use tax loss harvesting to offset gains without losing your market exposure. The question also changes from how much can I make to what is the probability of loss, and how large could it be? Because protecting what you've built now matters as much as growing it. A major loss doesn't just cost you money, it costs you time you would have spent compounding. At this level, investing becomes less about individual decisions and more about building a system that performs across different environments. Level 5. High Net Worth Investor. Your investable assets cross $1 million, and the financial system treats you differently. You are no longer limited to public markets. A threshold called Accredited Investor status opens and a different category of deals becomes available. Private equity, venture capital, real estate syndications, not traded on exchanges, introduced through networks, often locked up for 5 to 10 years, higher potential returns, higher risk, and far less information than the person presenting them has. The challenge at level 5 is no longer access. It is selection. Because once your capital reaches this scale, opportunities don't need to be found. They are presented. And the person presenting them almost always knows more than you do. Investing stops being something you do occasionally. It becomes your primary focus. Level 6. Professional investor. $10 million to $100 million. And investing is no longer something you do on the side. It becomes your primary function. A 5% return is no longer a percentage. It is $500,000 to $5 million in annual gains or losses. Every decision carries real weight. You build a formal structure, a family office or investment entity that manages taxes, reporting, and allocations efficiently. You track internal rate of return across every position. You compare everything against benchmarks. Consistency matters more than individual wins now, because a 50% loss requires a 100% gain just to break even. That math becomes very real at this scale. Your identity shifts. You are no longer just an investor. You operate like a portfolio manager. And your decisions begin to extend beyond your own portfolio. They start to influence where money flows. Level 7. Institutional investor. Hundreds of millions to billions. You are not managing money anymore. You are directing where large amounts of capital move across the economy. You don't focus on individual securities. You focus on allocation frameworks. How much goes into equities, private markets, credit, real estate. The individual deal is secondary to the structure. Liquidity becomes a strategic problem. You cannot move capital quickly without moving prices. Decisions are planned over quarters, sometimes years. You are not reacting to the market. You are positioning ahead of it. Your capital begins to influence outcomes. When you commit, others follow, because your decisions carry information. The market pays attention to where institutional money moves, and that attention creates its own effect. The best opportunities at this level are not found. They are shared among people who have earned the access. Investing is no longer about selecting assets. It is about directing capital at scale. Because capital this size doesn't just participate in markets, it shapes them. Level 8. Billionaire investor. Your net worth crosses $1 billion. And everything changes again. You are no longer thinking in portfolios. You are thinking in positions. A single investment is hundreds of millions, sometimes billions, deployed into one idea. Your capital is large enough to take ownership, not just shares. Control. When you take a position, the market reacts. When you exit, it is noticed. Analysts write about it. Other investors reposition around it. Your behavior is now part of the information environment everyone else is trying to read. You cannot move quickly. Entering or exiting a position requires planning over months, sometimes years. The cost of moving carelessly at this scale is enormous. Opportunities are never public. They are structured and negotiated privately among people with the capital and relationships to make them happen. At this scale, investing is no longer about returns. It is about influence. Where capital flows, which companies grow, which industries expand, which technologies get built. Because at this level, you are not reacting to the market. The market reacts to you. So here is what all 8 levels actually tell you. Investing is not one thing. It is a progression. And at every level, the rules change, the tools change, and a completely different behavior is required. Most people stay at level 1 or 2 not because they lack ability, but because they don't know the system has levels. They think the goal is better stock picks. It isn't. The goal is to build the behavior that the next level rewards. The beginner thinks about stocks. The retail investor thinks about allocation. The consistent investor thinks about compounding. The advanced investor thinks about optimization. The high net worth investor thinks about access. The professional thinks about structure. The institutional investor thinks about deployment. And the billionaire thinks about influence. Each level is not just more money, it is a different way of seeing. The earlier you understand how the levels work, the earlier you can start building the behavior that moves you through them.